I'm very excited to be spending this time looking at how to build an optimized stock portfolio. And whether you're doing this for a project related to a master's program or an undergraduate program, or whether you're interested in investing real money, and especially if you're interested in investing real money, this is a great tool that I think you're going to love. And I'm going to walk you through each and every step so that you get it 100% perfect and you're not sitting there wondering, did I do this right? Did I do this wrong? How does this work? What's going on in these formulas? How are they relating to each other? Because when the rubber meets the road, you're actually at one point going to have to decide, am I going to buy 15 shares of this or 25 shares of that? Do I really believe in this system that I built? And you're not going to believe in it if you don't understand how it works. I also see a lot of people talking about, oh, I like this stock, I like that stock, I like this company, and there's a lot of great content creators on YouTube. But one thing I'm always kind of wondering is, once people kind of pick their winners, they like these stocks independent from one another, how do they build a portfolio? I mean, if they have 20 stocks that they're watching or 20 winners that they like and they want to invest in, do they just put 5% in each? Or do they mix it up any way at all? Well, one thing we're going to really look at, and probably the main point of all this, is being able to come up with exactly the type of weights and the type of proportions that you want to have for the portfolio that you build. The other thing that you might really want to realize that is a great upside to this approach is that you may have certain stocks that you really love. Like there may be 3 or 4 companies that you are absolutely head over heels in love with. But one question is, what do you mix those with? What are good kind of pairs if you're thinking about, wine and cheese or these types of things from the culinary arts? What goes well together with the stocks that you absolutely have to have or the sectors that you absolutely have to have? One of the other things I'm going to look at is, what about credit defaults or credit ratings? We have Moody's, we have Fitch's, we have the Standard & Poor's. They all rate these companies, especially the large ones. How are you going to quantify that and factor that into your system? You want to be aware of 2 things. One, possible defaults or bankruptcies that could occur, and we've already seen that for a number of companies. As well as you have to think about when these companies go to borrow and they have lower credit ratings. Well, that means they're going to have to borrow at more expensive interest rates. And so that is something that you need to think, how can I build that into my funds or to my investing strategy? We need to look at how to calculate returns, holding period returns, and we need to understand how to annualize those returns. I'm going to get into all that. We need to do the same for the standard deviation. How do we calculate that? Do we want to take it from the population or the samples? How are we going to do covariances? How are we going to pull that data? And also how are we going to annualize that? We need to know exactly how that works, and I'm really excited to get into all of that as well. Because like I said, it's going to matter for exactly the number of shares you're going to purchase. If you change one thing, you get one thing off, I'm telling you, as I went to tweak everything, it matters a lot. The other things is, how do you set target prices for the assets that you want to buy? I see a lot of people that it doesn't seem like they have very much idea as far as, well, if it's trading at $20.20, do I want to buy it at 20? Do I want to buy it at 18? Do I want to wait until it goes down to 16? And so we're going to be able to use some statistical approaches in order to be able to give us some idea as far as what is a reasonable target price given how long you're willing to wait. Are you willing to wait 3 months, 6 months, to be able to get in at the price that you want to get in at? Or are you on a shorter time frame? Well, how do you adjust that? How to think about it? So that's very exciting. Finally, what about the risk-free rate? What about the Y? What's the Y star? What's the A value? If you don't know what these things are, don't worry. We're going to get into all of it, and so let's jump in. I want to start by showing you basically where we're going to end up with a more complicated example and then a more simple example. Okay, so at the end of everything, we want to build an optimized fund that has all the different assets, the ones that we're watching as well as the ones that we're going to buy. We want to be able to have certain things like, what's the credit rating, what's the cost basis, how many orders am I putting in today or this week, as well as things like how much money do I have either invested, as well as the amount of cash that needs to be in the brokerage account in order to cover any orders that are waiting to be filled. We're going to have all our tickers. We're going to have expense ratios. We're going to have something about a credit rating bonus if you want to add that. as well as the credit ratings, as well as the annual dividend yields. We're going to have target prices, we're going to have betas, we're going to have the current share prices. And once we get all this built out, it's going to even tell us how many numbers of shares should we purchase as long as we put in the most recent price or our target price. It's going to tell us the amount of money that we're going to invest in each asset. It's going to give us our baseline annual returns plus our dividend yields. But then we can adjust those, taking out maybe any expense ratios or other demerits that you want to give if the stock is a speculative stock or subprime. Again, the tickers, the risky portfolio weights, the PE ratios. We're going to be able to build in something that has the percentage that we have in each sector in mining, 5G and cloud, oil, biotech, diversity, or whatever other sectors that you choose to get into. We're going to be looking at the risk-free rate. We're going to be looking at the sum of weights, the A value, the Y star, the expected return for the portfolio, the expected standard deviation for the portfolio, the Sharpe ratio, and the Treynor ratio. So we have a ton of things, a ton of tools that once we build all this out, we're going to be able to have a really, really good sense of, how do we want to go about investing? And for purposes of growing wealth and taking, capital and investing it wisely, I think it's going to be great. So a little bit more simple example, just to kind of get to the core of where we're going with this, is really we need to know the amount of money we're going to invest. We need to really figure out the annual or annualized returns for each asset. We need to have the funds that we're going to pick, and then we need to know essentially the weights that we're going to have. One of the things in this larger portfolio that we're also going to do is we're going to be able to adjust our risk-free rate in case it changes. We're also going to be able to determine the beta of our portfolio. So there's all kind of things that we're just going to be jumping into. I can't wait. So first thing we're going to do is start pulling our data from Yahoo Finance. So go ahead and open up Excel and open up a browser, go to Yahoo Finance, and I'll see you guys at Yahoo Finance, and we'll start pulling that data. So I'm totally happy to share this with y'all. I haven't seen it on a lot of other channels, but what you're going to do is basically get your tickers of whatever things that you're hoping to pair with your, say, your star stock. Here's one, MUX. Basically go to Yahoo Finance, type in your ticker symbol, McEwen Mining, MUX. It'll pull the chart. You want to go to historical data. And the thing with doing some of the statistical work that we're going to be doing, it's going to be working with covariances, which is basically, a variance is how much does this thing change, right, over time. Well, covariance is like how much do two things kind of change together. If A goes up, does B also go up with it? Does it go twice as high? Does it go half as high? How much do these things vary together? How much do they covary together? Anyways, the trick with this, you can use monthly or weekly data, but you want to have at least 60 data points. So if we do 5 years of monthly data, that would be 60. It doesn't even have to be 60, to be quite honest. 30 or more is okay, 35 or more, but you definitely want 30, okay? So you can do 2 years of weekly data, or you can do 5 years of monthly data, whatever you want, whichever you like. Both are used. Historical prices, you don't want the dividends, you just want historical prices, and so that'll leave out all the dividends, which won't mess you up, and it'll make everything line up really great, really nice and even. So I'm going 5-year monthlies. And if you've never done this before, I'd suggest you do 5 years of monthly data as well. Make sure you just give a quick glance. You notice that sometimes it doesn't change on Yahoo. So we will get rid of this first one because we have the June 5th entry, and then we just want the June 1st, May 1st, April 1st. So we'll make that change later. But once we get that locked in 5 years, it will give us a CSV file. We will open that with Excel. We're not going to need to save this file. What we're going to do basically, like you see I did this on my last one, was another mining stock, is basically all we want is the date and we want the adjusted close. So if you're a Mac user, you can just press Control, Shift, and down. It'll copy the whole thing. It's already highlighted. You can press Command X to cut it. You can paste it right over the open column. And then why don't you just put the ticker in there so you can remember later what you got. Okay, now what I'd like you to do is have it like a separate sheet. Like a separate sheet here, where you're going to basically be copying all your data into. And what is basically nice, not everyone would always put the date in, but it's just nice because you want everything to line up. You want it ordered from like oldest to most recent. Everything just has to be really, really matched up correctly, and you want to be very meticulous as you do that. And so I would just really, really suggest taking the extra time, making sure that everything is super good. That way you don't have to come back later and be like, was that messed up? Is that one right? Can we, is that good? Is that okay? So, all right, so good luck with that basically, because that's going to be like a long process that isn't going to be too fun. But when you get done with these CSV files, you don't need them. You can just junk them. You're just pulling, like I said, the adjusted close and the date, and then you're basically just copying and pasting that into the master file that you're basically going to be building as you go. And then just back to Yahoo for the next one. And the next one, the last thing I'll say is you should be careful, because Excel does have a limit. I think it can only do, I don't think it can do bigger than a 20 by 20, and it might be even smaller than that. I think it might not be able to do bigger than a 15 by 15. So 225 cell matrices or matrix. So okay, so the next step that you're going to want to do after you've pulled all of your data, all your prices out of Yahoo for either your 5 years monthly or 2 years weekly data, is you're going to have it all pasted and copied and pasted into your sheet that you're building. And you're going to realize, you can see here, that we only want the first of each month. Now it's nice that Yahoo took out the dividend payments and cleaned that up for us a little bit, but we still have this, like when I downloaded it was the 5th of June, so I don't need 2 entries for June, right? I don't need the 1st of June and the 5th of June. So I want to get rid of this entry here. I am going to leave the date, okay, because that's going to just help me remember what's going on. It should be blank, that's no problem. But I'm telling you guys, when doing these things, the more efficient, the more detailed you can be in your labels, whether you're talking about a logarithmic return or an arithmetic return, whether you're talking about excess returns, if you don't know what that is, or not excess returns, standard returns, then just not having to go back and trace through the formulas and look at where is this linked to and where did it come from and what is this. It's so much easier just to have everything labeled nicely, and so you don't have to be scratching your head. You don't have to be wondering, did I do this right? You don't have the anxiety of, is this wrong? Is all my data, all this hard work going to be correct? Now, some people may have thought, it's stupid to put the dates for every single entry, but check this out. Look, I'm all good until I get to my very last entry, and then I have a problem. You can see here I have this last stock has one extra row, and so what in the world? I could go up to the top here and look to see what's going on, and we could see that it starts actually 1 month earlier. These all start in July of 2015. But this last one here starts in June. So we have an extra column up here that we need to get rid of. We need to copy and paste and move everything up one. And so that's going to be our real issue. So we got to be careful there on that end. The rest of these, otherwise, we got to just get rid of the 5th of June 2020. So I'm going to do that. I'm going to delete those. That'll be blank, just how we would like it. Obviously, like I said, we don't need duplicate entries for the month of June in 2020. But I want to keep that blank there so I know just what's going on. Keep that little date there. Nice for me, so I'm not like, wait, what? And it'll happen, and it's just a big waste of time, and it makes the whole process a lot less interesting. So what we need to do here, again, we'll get rid of the 5th. We don't need that there. And we want the 1st up to the top, but we're going to get rid of this one right here. So the interesting thing with Excel, you may be thinking, okay, if I copy and select it starting from the bottom and then come to the top like this and paste it, is it going to put all my data up here? Is it going to move it exactly how it is? Well, I mean, it's just good to know how it works, I guess, but no, it shouldn't. It should just do exactly, basically move everything up just that one row. So now we're looking good. We have 7/1/2015, 7/1/2015. We're going to come down here. We're going to expect that we have the same number of rows, everything lines up, 6/1/20, 6/1/20, boom, 6/5 is blank. Great. So I'm actually going to delete this one here. Actually lied, I'm going to put this one right here, just for now, just so I got a good sense of what's going on. And that's it. Okay, so anyway, basically probably the fastest way to get rid of these dates is just delete the columns. You can just go along, and it's fairly quick. Just getting rid of the dates, getting down to the prices only. This is my last one. This is great. Now, I know you guys maybe think this is lame, but I'm actually going to copy and paste my column row over here on the other side. And I like to do all kinds of stuff like I like to, I don't know, do underlines, or I like to make it very visually easy to, oh, and I missed a couple right there, so I'll have to come back and get those. I like to make it very easy visually to understand what I'm working with. So like, maybe we'll underline the headers, maybe we'll make them bold, and maybe we'll even make these ones sort of a dark blue. Okay, cool. So that way, it's just a little bit clearer. And change the fonts. Oh, and you know what? I probably, because I have all my prices right justified, let's do the same thing with these, eh? Put those on the right. That way it's very clear. The date goes right above the prices. Now here's two that I need to get rid of. But I think I have some data above here I don't want to delete. Ooh, that's not true. We're good. So R and S are clear. So we can get rid of these two. Ooh, actually these three. These four. Delete these columns. Great. Look at that. All cleaned up. Looking pretty for Friday night. So now we have all of these stocks, and if you're curious about what I have going on here, mostly for me it's a lot of mining stocks, materials, and stuff like that. And yeah, some tech companies, some oil pipeline, oil shipping, things like that. Great. So I'm pretty happy with that at this point. So now we can get to the business of coming over here, and instead of doing a big prices thing, so my prices are going to have this blue color to it, I can come over here and do like a new line of, I don't know, let's make it a different color. What color do you guys want to make it? Let's make it this orange fill. Okay, so this part is really exciting. We finally pulled all our data, we've gotten things organized, we've got our prices, we've got our table set up nice and neat with dates running along the outside, and so you're getting there. Now, you get to this problem we've talked about, or you may be aware of, but averages. You want to start doing your returns, and you're going to run into this different thing. Well, should I do the normal arithmetic average, or should I use the geometric average at this point? Well, the thing is, I want to show you guys this just to make it very clear. When we do our month over month, they call it the holding period return. When you're just going to hold for 1 month, you're just going to use the arithmetic return on that point, okay? And it's going to get, it may be really confusing because you're going to hear a lot of people in finance say, look, you want to use the geometric averages when you're looking over a lot of periods, multiple periods. That's true, but if you're only looking at 2, you're going to use the arithmetic average. Now, I'm going to just try to make this as clear as possible because I think this is not often well expressed by a lot of people when they talk about the various steps as you go. So the step that we're on is basically we're going to look at what is my return right here. Okay, I got my Broadcom stock, and I just want to know what is supposed to go in this cell here. Okay, the return from July to August of 2015. What do I do? And what I'm telling you is you want to put in the arithmetic average on this point. And so you can look up here, there's basically 2 ways that you can key that in. And you'll notice that here in the green box, I just did an example of what I want Broadcom to say. It's going to be 0.006632 317. And you can see I can arrive at that calculation by two different ways. And I put the expression or the formula right here. And you can see that these two match exactly. The first way you can do it is you can take the later date, so the August price, these are my prices here, the C217 is my August price, minus the beginning price in July, C216, divided by C216. So you can memorize it or however you want, but it's basically the end minus the beginning divided by the beginning. And that's the way it's often said. Now you can see that's a lot more characters and a lot more ways to mess it up than if you just do it this way, which is the end divided by the beginning minus 1. So there's no parentheses, there's less functions, there's less typing, there's less clicking on cells. So a lot of people prefer this. I just think it's nice to point out to everyone that there's two ways you can get there, that these both get you to the same place and you'll see both, and so it may be confusing if you see this and you're expecting that or vice versa. Now the same is true with what is called log returns, or they go by another name called geometric returns, averages. And so again, same type of thing. You can take the natural log of the end date minus the natural log of the beginning date, and it'll give you this 0.00661042. And you can see that the yellows match, but you'll also notice that the yellows do not match with the greens. So it's very, very important. If we're going to get this spot on correct, we need to know which ones we're supposed to use at which point in the process. So at this phase in the game, the next phase that we're going to do, the month over month, the single period, the single month holding period return, we're going to use the arithmetic averages. Then when we go to the bottom and we want to find the sum total, the cumulative average of all of our months or all of our weeks, whichever one you're using, that's when you switch to geometric, okay? But at this stage, don't go geometric. At this stage, go arithmetic first, okay? I want to make that clear, and you can use that two ways. I'm sorry, I bounced around on you guys. Also look that there's two ways to arrive at the geometric average, or the log average, the log return, you can call it. You can either do ln for the later ending month minus ln of the beginning month, and that's it. That's all there is there. There's nothing extra. So what we're going to do, just like I said, we are going to do exactly what I have here for Broadcom, the arithmetic average, and I'm just going to do my C217 divided by C216, subtract 1. That one's nice and easy. And there's exactly what I'm looking for right here. 00663217. So that's great. And so that actually, if I want to trace my formula, I can go back over here to my prices, and it's going to be the later month divided by the earlier month minus 1. And that'll give me the arithmetic return, which is what I want at this phase of the game. I know that's, I don't know, I think it can be very confusing for everyone. So what we're going to do is we're going to pull that down. It's right here. Then we're going to pull it over. It's right here. And that's good. And like I said, just to reiterate, just to be very clear, that first step, you want the arithmetic returns. So that's why I labeled it arithmetic returns. All right, so we're rolling. We have our examples here. We have our Broadcom stock returns, the arithmetic month-over-month stock returns. Come down here and you want to grab the geometric monthly average of the arithmetic returns seen above. You can use it two ways, but it's the same thing that we always do. We're going to take, now I'll blow this up in the video, but you're basically going to take the product of each return plus 1, you see that there in the parentheses, and then you're just going to raise it to the power of 1 over 59. At the end you're going to subtract the 1 that you added in the middle of the formula, and it's 0.18%. This monthly return, okay? So 1.8% monthly return. You can do a different way if you like. There's always multiple ways to key it in. But if you want to see this, this is just sum product, parentheses, geomean, parentheses, the array that you have, your returns above, plus 1, double close parentheses, minus 1. So it gives you the same thing, or you can do it the more traditional way that we always find geometric average, which is just you take all your returns, you add 1 to each of them. That's what we're doing here in this first parentheses. All your returns, you're adding 1 to each of them. Then you're taking the product of those, and you're raising that to the power of 1 over the number of entries. In our case, 59, and again, minus 1. So there you go. Yeah. Okay. So anyways, now the thing is we want to annualize those returns. Which is pretty great. We know your monthly, so you're just going to multiply by 12. Equals star 12, and that is your 21% annual return. Pretty good return there. Get rid of that. So it's pretty cool. At this point, what we're going to be doing is just, doing the same thing, right? We're going to be doing it for all of our stocks that we have at this point. So let's see, once we have it set up like this, it's fairly easy. You just have to get the first one right, and then it's just drag it and pull it. There's nothing really that crazy what we're doing. You can always go back and check. And we'll pull this across just to double check, because why not? Then like I do, especially on these big tables, I want to have a little something on the other end. So I'll copy those labels of what this is, what these numbers are. But these are matching up, so that's great. Do I want a space there? I will have a blank line there. This, we don't need that anymore. Pull this across. Good. So we have our annualized geometric returns. And you know what? Before I type that in, let me make sure monthly. So it's equal stdev.s for the sample. And then it's just really easy. You're just, again, clicking the cells that you want. And this is really important. You have to realize we're doing this on our returns, on our arithmetic returns. We don't want to do it on our prices. It has to be on our returns. We'll pull that across, so just do the same thing over on your screen. And then I'll do sample, standard deviation, annual. And the thing is, what we're going to do here, may seem a little bit weird, but we're going to do the monthly times SQRT square root of 12. So I know that's weird, but it's just how it is if you want to annualize standard deviation to multiply it by the square root of 12. Wow, big standard deviations on some of these. 24%, 63%, 53%, 60. So when I do my fraction, what we're going to do next is the Sharpe ratio, which essentially is just a really, really easy way to determine how much return per unit of risk am I getting for my investment. So you could kind of think of it as like your salary if you get paid by the hour. How many dollars per hour of work am I getting paid here? That's essentially what the Sharpe ratio is. You do want to exclude, or you want to take out the risk-free rate, and so we can do that. Okay, I like that. So I'm going to use the IEF sticker. It's iShares 10 to 7-year Treasury bond. It's ETF. So we'll go down here and we'll do the exact same thing that we did in the past. We're going to grab the historical data. We're going to do 5 years and monthly returns. We're going to need to subtract out the risk-free rate from the rates that we got on each of our equities in order to be accurate. In order to accurately calculate the Sharpe ratio and some of the other things that we're going to be doing in the future. So it's going to be important. Okay, so we pulled the risk-free rates from that ETF, the IEF, that we're going to use for the risk-free rate, the bonds, prices, treasuries, 7 to 10-year treasury bonds. So we have all the prices here. We did the same thing. We took the arithmetic returns, just the end minus the beginning divided by the beginning. We got our holding period return for each month. We came down here, and this is the thing that's so important. We're going to do the geometric average. Just like we did for all the stocks, we're going to do the same thing. So it's product times the array plus 1, just like we did in all the examples. You're just taking the percentage return each period. You're adding a 1 to it, and you're multiplying all those together. Then you're taking the exponent to the power of 1 over the number of periods, and then of course you're subtracting out your 1. It's the same thing we've always done, and I'll zoom in on it here, but there's no tricks really. Same thing. We're going to get this, and I highlight it because it's super important. Basically, before we go to calculate our Sharpe ratio or our Treynor ratio, we need to know what our returns were on each stock, and they need to be excess returns. That's what they call that term. Excess returns is always what you want to use, and what excess returns are is basically what gains did I make above the risk-free rate, and so that's why they're excess. Anybody can go out and get the risk-free rate at pretty much zero risk or no risk, or that's why it's called risk-free. But we want to know, we took in a little bit of extra risk. What did we get for it? What did we get? Anybody could have gotten the treasuries. We went and we got Broadcom in this example, or Cisco. How much did it pay off extra? That's what we're interested in. And then we're going to divide it by the volatility that we experienced. So that's what we're going to do. So it's very simple. You just set it up right. I used the green ones to do any returns because that's like money, right? And then I left the standard deviations in just the black. So just helps me. So this is the geometric monthly averages here, and then the corresponding standard deviation, the monthly standard deviations. Then we calculated the geometric returns. And again, I guess I might as well just show it to you because I want you guys to get it. I want to make it easy. So on the returns, we're just taking the monthly returns and multiplying it by 12. That'll annualize it for us. It's very simple. The only trick with the standard deviation that's a little bit different is you take your standard deviation from your returns that you have, and we're doing monthly. So first let me tell you how to do it with monthly data. So with monthly data, you're just multiplying it by the square root of 12. So 12 periods per year. So you're just taking the standard deviation that they gave you, which was just stdev.s, going on the range of returns through arithmetic returns that we found earlier. Pressing return, enter, very simple, gives you the number. You want to annualize that to get your annual standard deviation. You just take that number right here times square root of 12. Okay? If you're doing this project with weekly data, then there's 52 periods per year. So you are going to multiply your weekly standard deviation by the square root of 52. Okay, I'll just say that one more time. If you're doing weekly data, then you're going to take your standard deviation based on your weekly returns that you found, and you're going to multiply by the square root of 52. It's fairly simple. It may be strange, but just trust me on that one. Okay, so once you have both parts, you have your risk-free rate return annualized. You make sure it's this one. This is the really important one. See, you got to always make sure you're doing the same thing. So we're going to take, for each stock, we're going to put in the formula, we're just going to take the the returns that we got, the annualized geometric returns. These are, and then we're going to subtract the risk-free rate that we found. So just one more time looking at each thing. I could even call this the annualized geometric average returns, if you want to call them that. But these are the annual, and it's just an average, like we did, of our returns, and then the corresponding standard deviation. So we're just subtracting the annual rate of return that we got on our stocks minus the risk-free rate that we could have gotten in the treasuries. Now, remember, you want to put those dollar signs around the treasuries. I always put it on both, and that's going to give you your annualized geometric excess returns. Now at this point, all you're doing to find your Sharpe ratio is you're just taking your annualized excess return and you're just dividing it by the annualized standard deviation, sample standard deviation that we found before. So, and I'll go slow because I hate it in these videos when people go too fast, but again, you're trying to find the Sharpe ratio. It's just the annualized geometric excess returns that we found divided by the annual standard deviation for each stock. So that's pretty cool. No dollar signs needed there. We can drag that across. And so this is pretty good. I'm pretty happy with that. Why? Because it gives us a sense of basically which stocks are doing well. So now with the Sharpe ratio, I really have a good sense of which ones are performing well and which ones aren't. And I might go through with like the highlighter and just, pick maybe the ones that I really like. So basically the higher the number, the better, because remember again, what's in your numerator? It's your excess returns. Those are good, divided by the risk that it cost you. So if you could get a lot of returns for the same amount of risk, then you would want that. You would want a bigger ratio whenever possible. So you're just going to go through. Some of these are going to be negative because some of the returns are going to be negative, especially once we subtracted out that risk-free rate. So like this one's negative. Groupon. Groupon had a really bad 5-year run. They've had they definitely lost a lot of money. Yeah, definitely lost a lot of money. And in fact, what I'm going to do is I'll go back here and I'll make sure that I just keep these in green. I hope that you guys aren't using such a big number of stocks. You might be though, and that's fun as well. But the bigger it gets and the less that you can see what you're looking at, the nicer it is to have some kind of visual cue, because otherwise you just get stuck in this massive maze of basically small numbers, right? So, like I said, I'm going to copy the same labels over to the far side of what I'm doing. I like it like that. So that's good. And then, like I said, we're basically going through looking at these Sharpe ratios, seeing, it's just a very simple measure, but seeing what is attractive. Now, some people don't like to measure it this way. This obviously isn't the only way to pick stocks or evaluate stocks. You can go and look. I mean, we're not looking at the balance sheet here. We're not looking at the statement of cash flows or the income statement. We're not looking at the CEO. We're not looking at the sectors. We will go and get the betas later. The Treynor ratio is essentially, it's the excess returns, just like with the Sharpe ratio, the numerator has the same thing, the excess returns that the stock has. But the denominator is the beta in the ratio. So some gold mining stocks that are down 7%. Others are up 7%. This is over 5 years now. I mean, we're not day trading either. Some of these stocks are up like 80% on the year. So, and you have to remember these numbers here, we're not looking at returns anymore. This is the Sharpe ratio. This is the ratio of the return that we got for each unit of risk. That's another way to say it. So Crown Capital International is a company that does like data centers. It's a REIT, so it's a real estate investment trust. But yeah, just really interesting. This last one is like a company that does space components, so they had negative returns. But anyway, yeah, you can't have negative standard deviation. So you can't have negative beta. Beta is kind of like a multiplier. Like if you have it's always in relation to a benchmark. So say I have a stock that has a beta of 3. It means that whatever the beta is based on, say it's based on, say the S&P 500 or the FTSE or the DAX or whatever you want. Just pick something, right, for this example. If the DAX, we'll say the DAX goes up by 100%, the beta is like a multiplier effect. It measures how much is my asset going to shift for each shift that the benchmark makes. So like I said, if the DAX goes up 100% and I have a beta of 3, my stock will shift up 300%. Now, the other thing that you can say is that it's possible to have a negative beta. So that would just mean that when the DAX goes up, my stock is moving in the exact opposite direction. So our stock price is going down. And sometimes that can be nice, if you want to especially have certain things offset each other, or you want to have some kind of diversified portfolio, if you want to have less volatility built in, if you're scared of the big ups and the big downs and you don't want to experience any major losses. It's however you want to do it, but that's kind of what the Treynor ratio, it gives you another sense of, what are you getting for your risk. And beta is one way to think about risk is how volatile is this. We know that there's volatility in these markets. We see that every stock, is up and down over month, and, it's just not always a linear progression upward or downward. It's all over the place. So like we saw with some of our examples with calculating the averages, the averages, if you use arithmetic averages, the volatility doesn't really matter, but for us it does. And so some of those more volatile stocks, it's gonna make a difference. If you think about gaining 10% and losing 10%, just play around with some examples like that. If you start with like $100, and you gain 10%, so then you're at 110, and then you lose 10%, well, you lost $11 on that second move. So at the end of that first 2 periods, you went up to 110 on the 10% upside. You lost the next 10%, which is $11 loss. Now your portfolio is at $99. So, you think, well, hey, I mean, what the heck is the deal with that? I up 10% one day, down 10% the next. It matters, and so the more volatile those stocks are, the more that kind of thing will happen to you. So that's the Treynor ratio in a nutshell. So what I want to do then is I want to copy the tickers that I have and paste it down here because I'm going to make a new monthly, you can see monthly here, covariance matrix. So it's going to be important because since our returns are annualized, we need to make our covariance matrix that we're going to use for our standard deviation. It also needs to be annualized standard deviation. So that's really important, and we're going to make sure that we get that done. So what I did is I went and I copied and I pasted, you can see here, like I'm going to paste those things, okay, right? So maybe this is the thing, I'm going to paste it across the top, which is fine, no problem. That shouldn't, but if you're not a big Excel user, maybe you don't know about the special paste, which is called transpose, which is really nice. And so it's right here, transpose, which is going to do the same order, but just in a column instead of across. So that's really nice because it helps you if you're not sure how the heck, just those little tricks are, I think, 90% of the battle. Now, what I would like to do is I actually don't like this here because it's like off one. It's like off one column. Oops. There we go. So if I do it here like this, yeah, I like that better. That way it lines up exactly with, with that. So, perfect. So again, just being really neat, keeping Broadcom and SOX, ABGO, right in line with where they already are in this table that I'm building it from. Okay, so now what I want to do is I need to go to Data, the Data tab, and I'm going to go to Data Analysis in order to build the covariance matrix. And what we're going to see is that that transpose thing is going to come in real handy here in a second. So I need to go up, it's covariance, alphabetized. Okay. And I need to select the range, first of all. So let's go ahead and do that first. Here's what I've got. Here's what I've got. So we'll do it like this. We'll copy. So then once we select all the table of returns that we're going to use just for our new covariance matrix, we want to output it. I think we can just press that upper left one. Let's see what happens. I did not do labels in the first row, but I could have, but they wouldn't have been so cool looking. So we'll see what happens if I do it like so. It's automatic formatting, it's thinking, it's an old MacBook, a lot of programs running. Oh, we missed it by one, shoot. That's okay. Cool, so we have our 10, what we need to basically do then is you can tell that it just gave us half. We are going to highlight this, and what we need to basically do is mirror it. So what I mean is that we need, if this is our middle line, we need everything that's like this would need to be here. So the 0.001987, this would need to be here. Likewise, the other really easy mirror to imagine is this corner needs to also be duplicated in this corner. So it's because anytime that CCI intersects with AVOG, well, it intersects with it in two places on the table. So everything intersects with every other thing, two different places in the table. And then each thing intersects with itself at 1 point on the table. Okay, so I'm going to get it lined up so it looks nice and good. Okay. And then I'm gonna copy the whole table. I'm gonna come right here underneath it. I'm gonna click there, and I'm going to go back to home because I want to special paste, but I want to transpose again, like we just did. So I'm gonna transpose, paste that, and you'll see that this number is the same as this number, and that this 00316180 00316180. So what I'm basically going to do now is I'm going to then copy what we just pasted, but transpose pasted. I'm going to cut it. Maybe I don't. Oh, I don't need to transpose, but I do need to skip blanks, and I want the values and number formats. Okay, so since we already transposed it, we don't need to transpose it again, but we do need to skip the blanks. There. That looks pretty. This one matches this one. The third down ends in 47. The third to the right ends in 47. This one ends in 817. In this bottom left corner, top right corner, 817. Okay, so now we're cooking with butter. Oh, cooking with butter. All right. Get that to stop doing that. Press escape. Now the thing is, all we need to do is getting everything cleaned up. We will add, just like we always do, our tickers vertically, and horizontally. And then we're going to label this the annual or annualized covariance matrix. So annualized would be better. AD would be the better way to say it. Now this is fairly simple. We're just going to multiply by 12. So we're going to take all the monthly covariance entries, and in order to annualize covariance, you're just multiplying by the number of periods that you have in a year. So my data is monthly. We can see it right here. So I'm going to be multiplying by 12. If you're running with weekly data, then you can do times 52 here instead. Okay, but for us, we're going to go back to 12, and it's just very simple. You're just clicking on your cell, and you're making sure to add those dollar signs on the cell that has the reference to the number 12 or the number 52, whichever it is for you. I'm going to hit return. And then, yeah. So just to be clear, I know that we were using the square root of 12 previously, but that is only for annualizing standard deviation. Okay, that's not what we're doing here. These are covariances, and those are treated differently. So covariance, just to be very clear, is going to be multiplied by the number of periods in a year. For us, we're using 12. In other cases, you may use 52 for weekly data. Anyway, you're going to distribute that just by dragging and pulling it through the rest of the cells. And then really what you want to do is we're going to leave this here, and we're going to copy it, and then we're just going to paste the values in to our major worksheet that has this in it. So we'll just be copying and pasting those exact cells right in here. A few steps ahead, just so that you have an idea of what you're going to need to start building. This is going to be a second sheet. So we have on our one sheet all of our calculations that we've been working on. And I mean, that's great. The annualized covariance matrix, the monthly covariance matrix, all the Treynor ratio, the betas, the annualized, all the stuff that we've been doing. Okay, that's going to be in one tab. And you can just open up another tab, a new tab, and you're going to basically need to start building something like this. So I thought I'd just show you. You're going to need at least this many columns, and before we get done with everything, we're going to add a whole lot more to this. But just start with these things. Do a column with amount invested, and at the bottom of that, put your total amount, whatever you have. You're going to basically do annual returns. You're going to do the names of the funds, and you're going to do a column for the weights. You're also going to, off to the side, have a couple tabs where you can do, like, say, a sub-fund weights for stocks, or for me, I'm going to have one for oil. I'm going to have one for gold miners. I'm going to have one for 5G. So you can just, just kind of lay that out. You're also going to have one for a value called the A value that we use. Down here, we're going to need a couple other things. The sum of all your weights, meaning the sum of all the weights here. Okay. You're going to need a space for Y star, and we'll get to that. But just for now, just leave the cell next to Y star blank. You can do that. We need one for expected return, one for standard deviation, one for the Sharpe ratio. And why don't you underneath here put another one called the Treynor ratio, and that is spelled Treynor. Okay. The other things you're going to want to have is a space for the risk-free rates, and that will be nice. You can, if you like, I would suggest maybe just doing this in case you ever mess up your formula for your either expected return or your standard deviation. You can have it here in an adjacent cell, so you can just go and copy and paste it right in and get back to work. Like we also said, we pasted in the covariance matrix, and we're eventually going to reference that using some of these references. But I just want to give you an idea of the things that we're going to need here. And I do suggest the color coding because sometimes it really helps you. Just try to be neat, and but you can customize it how you like. But I'm going to go back to the other video, and because it's going to take you some time to build yours, I'll just let the video roll. You can watch me build mine, and I'll just give you some ideas about where we're going next. Alright, so I'm just going to keep chatting here because I don't think it's a big deal. I don't think I'm being like that annoying to you guys as you work. And there's not going to be like big pauses. Okay, so we have our stocks. Try to make them a little bit of formatting here. Okay, so then what I would suggest doing, like I said, is so that you can keep your annual returns as they are, go and grab your annualized or regular annual returns, not your excess. So I'll just show you what I mean. Not your excess returns, but your standard returns for these stocks. So what I mean, this is the excess return one, not this. Let's go ahead and subtract out the risk-free rate separately. So this is our annualized risk-free rate that we use. So let's just start by copying and pasting that value. And we can link it. Maybe we should link it just so we know where it came from. How about that? So we will set this cell equal to the annualized risk-free rate that we found right here. This is our risk-free number. Enter. Okay. So that's good. That looks perfect. That's our risk-free rate. And then on these are our annual returns. So here, of course, you want to put in your whatever you guys are doing, like 8 million each or whatever you're doing. I hope it's more than that for you guys, but if it's not, that's okay, don't worry. So since you have a risk-free rate, these annual returns, we want those to be the rate before subtracting out the risk-free return that is expected. What I mean is the geometric monthly averages, not the monthly averages, the annualized geometric average returns that we got. So the 21%, 13%, the 5%, the 10% that you see here. So leave this alone. This was just for our Sharpe ratio calculations, and we'll go ahead and we'll build a little bit better model. That way we can adjust the risk-free rate fairly easily. And we can see it also, what we're assuming the risk-free rate is, without having to jump around and hunch around. So go ahead and start with your first one. Yeah, and again, I guess you can just maybe put some grids in there. So we'll link this to this return right here. Good. The next one, my SOX. Cisco was good too. 42%. Maybe I'll come back and I'll put that in later. Okay. Tesla. We'll see how good this does. I don't know if this is going to be a good one or not. But see how nice the green is at this point, where it's right there. You can tell exactly which one is the revenue. You don't have to worry about the standard deviation line. You can just almost look without going back to reference the table. So we're doing GDX here. See what I mean? I know that I only have 2 green return lines to choose from, and I know the bottom one is the excess returns. So I can just pick this one. I don't have to mess with it. GDX. Now the problem is that we got to be careful, with this all linked together like that. Oof, I forgot what I was doing. GDXJ. If we ever make any changes to our returns table, just got to be really careful. At this point, I like to put percentages in because now it's kind of not a big deal. We're not running calculations or anything like that. Okay, so we have our stocks, we have our we have our risk-free rate. That's done. Yes, this is just going to be the sum of all the weights. Should always add to 100. The Y star is the formula, which is the expected return here in this expected return box, minus the risk-free rate, which we have here. The decimal, that's fine, no problem. Divided by the A value times the standard deviation of the portfolio squared. So that's great. Expected return, this is cool. The formula, it's MMULT, parentheses transpose, parentheses your weights, and then close parentheses in that, comma, and then your the array that has your annual returns, and then double close parentheses, and that'll hook that up. So that'll multiply basically across and dump it all in here. It's no big trick, right? It's just a weighted average. That's all it is. So it'll drop the weighted average in your expected return for your portfolio. Now the standard deviation is the big one. It's a bit more of a crazy formula. For one, it's going to be, and you have to make sure you get all this stuff right, but it's the square root open parentheses, MMULT, open parentheses, MMULT, open parentheses, transpose, open parentheses, J14, so this is your weights, so J14 to J20, and I need to actually move mine up to include all of my weights, so I have 10 weights now. So J12 to J20 for me, and then close parentheses, comma, then you're doing H, your H column, which is over here, H32 to N38. That is going to be your big bad annualized covariance matrix. So I need to update mine, but that'll be good. We'll adjust as needed. And then the last part is close parentheses, comma, and you're doing again another, you're doing again like another array. These should just match, basically. Why are you doing it twice over the same information? I don't know. And why does it change when you click off of it? Well, you have to press Control, Shift, Return. You have to click on the formula bar, Control, Shift, Enter, and it'll put that in there. So the problem is, for me, that I'm having is I have too many. I only have an 8x8 matrix while I have a 10x10 or 10 rows of weights. So it's not understanding what's going on. It's saying, what the heck? So what I need to do is come back over here, and I need to take the matrix that I built last time. Which we just built. It's below all this. And remember, it's not the monthly covariance matrix, it's the annual covariance matrix. So I need to, I'll just take this whole thing over there. I'll remember that my top left corner cell is the title called Annual Covariance Matrix. And what I'm going to just do is copy it. I'll leave it there, it's no problem. I don't really want to reference it to another tab. I'll just bring it over here to this tab. So I want it basically right there. And I'm going to special paste the source, formatting, and values. So values and source formatting. Great. And that's super small. That's fine. Load up a little bit here so we can see what we're working with. We don't care if some of those numbers disappear. And such a stickler. That's kind of cool. Okay, so now we have a full 10 by 10 matrix. And you just can't see these because these rows are so small. But they're there. They're there. We're all good. You don't have to see them in order to be able to calculate them. So now that we have our 10 by 10 right here, front, live, and center, we can go back up here to our standard deviation of our portfolio. And you can see what I was saying. See is only didn't have enough information. So if I give it what it wants and I make a full 10 by 10 there, then I'll press Control Shift Return. Okay, so I had this one little error and it messed everything up for me for a bit. I had to go and figure out where it was. The color coding is nice, you know. I don't know. I had this one line up, so it just wasn't working for me on the standard deviation. I also copied and pasted the formulas here so you could see how it works exactly. So this is the formula for the expected return, and I'll click on this cell so you can see it, but it's just, and it's still wrong actually. So it should include all of your annual returns and all of your weights. And so it's the matrix multiplication, MMULT, parentheses transpose, parentheses my J is my weights, comma, and then the array for the annual returns, and then double close parentheses. So that one's not too hard. The thing with the matrix multiplication, in order to activate it, you need to press Control Shift Enter. Control Shift Return, Control Shift Enter. whatever you like, but all three of those at the same time, and it'll lock in the rate. Now this was the one I was having trouble with, but basically both, you can see both, there's going to be actually two sections, like a blue and a purple. I don't know if you can see that, but basically you're going to have in the formula the same weights highlighted twice, and that's how it's supposed to be. So again, the formula, square root, matrix multiplication, square root, parentheses, matrix mult, parentheses, matrix mult, parentheses, transpose, parentheses, J12 through J21, that's the weights, comma, then you're going to highlight your covariance matrix down here, like you see I've done. So for me it's a 10 by 10, and then close parentheses, and again that same weights column, double close parentheses. Again, since it's the matrix multiplication, Control Shift Enter, and that'll lock it in. So that's pretty great once it works. Then what you basically want to do, everything should be filled in at that point. And so then what you basically want to do is go to data, whatever. Go to Solver, open up Solver. You may have to add Solver, and I think that's under the, maybe under Tools. Add a, I don't remember. But what you're basically going to do is it's going to open up like basically the parameters, solver parameters, you can see here. So set the objective. So you want to click the Sharpe Ratio. And I guess I didn't tell you before, but the Sharpe Ratio, just like we did it before, was the it's the expected return minus the risk-free rate divided by the standard deviation. So that's what we're trying to maximize. So we're going to go click on this little underscore here. We're going to click maximize that one. We'll come back to maximize it by changing which cells. Well, we want to change the weights, right? So we need to make sure that it's just, and then again, this is why I'm such a fan of the colors, because it just makes it, it basically just makes it easier, less mistakes. So by changing the weights, we are going to maximize the Sharpe Ratio, and then we have the certain subject to the following constraints. And so those constraints would be, do I want J22, this is my J column 22, to be less than or equal to 5? Sure. Like, I don't really care what my risk aversion is at this point, so we'll just let that fly. I don't want it to be over 5, since that's the max, and it is part of my formula, so I need to constrain that one. What about this next one? J24 is equal to 1. So J24, some of the weights does need to be equal to 1. So that's true. That's this one. And then J25 also equal to 1. So that's my Y star. Yeah, so in this case, the Y star, I'm not going to leverage my portfolio. I'm not going to borrow any money. I just want it to be equal to 1. So that's a good constraint. Now, do I want to short any of my positions? I'm going to use shorting either, okay? So that's what this check mark says. Make unconstrained variables non-negative. So actually, yes, I don't want them to be negative. I want them to be non-negative. So I'm going to check the box. And there's now a bunch of different methods that they can use for solving. We're going to go ahead and let it run. And so it'll say in the bottom, it's going to run a number of different trials, trying to find the best mix, the best payout. Expected return 18.5%, standard deviation 23.8 is what it's looking like. So you can see on the left side all those different things. So solver found a solution, all constraints are optimally satisfied. Okay, so we'll keep those. And basically, they would like me to put 100% of my money into the gold miners, the junior gold miners fund. Pretty interesting. Who would have thought? I would have thought that. So this time I took off the borrowing limit, the Y star, and I let it go to leverage it, 510% leverage. And what happened was, So it's really able to drop the standard deviation. I got a much higher Sharpe ratio and a different mix, a significantly different mix by taking off that one restraint. I'm going to add that back on though. I don't want 510% leverage. Yep, I like that. So again, a little problem, you miss one little thing and you have to realize that you can see here that my constraint for the sum of weights equals 100%. That's correct. Well, how is that possible? 94, 6, and 484, right? Well, obviously what I realized was that my problem is my sum of weights didn't include all my stocks. So I needed to include all my stocks. Now I can't have 548. So that was clearly wrong. That was clearly a problem. So there we go, baby. Keep going. 0.89, 0.94. Okay. So now the solution is 61% in Tesla, 39% in Newmont Mines. Yeah, it's important to get everything right. So that looks really great. So, so basically, after running it a couple times, it was really easy to make certain mistakes. You just have to make sure absolutely that all of these columns are included and summing to one. You just have to make sure that everything lines up. If you get weird numbers, it could really be that you have one stock that is optimal among all the others. But I mean, it should be surprising if you ever find that it only picks just one stock for you. If you don't like what you found, or if these didn't seem to help your portfolio, you can go back, create a new table, create a new covariance matrix, and then try writing it again. Just copy and paste it back in here, and then keep, like I said, have a different tab where you have all of the, basically like the annual covariance matrices that you used as you went along. And then you can always go back and plug and play and look at different combinations. And you can, for example, you can change certain things. Like if you wanted to allow shorting, you could make unconstrained variables non-negative. And so if you want to let those be negative and you want to short any of your positions, if you have the ability to do that, I mean, it should definitely give you an advantage. So we can see already we have an improved Sharpe ratio if we include shorting. So it's up around 1.5 at this point, whereas before it was right around 1. So we have an expected return of 50%, standard deviation though of 30%. Solvers converge to the current solution. All constraints are satisfied. Okay, so in this scenario, it has a shorting Broadcom, 200% in an ETF for the manufacturing, semiconductor manufacturing. Tesla 17%, shorting the gold miners, really also shorting the junior gold miners. Now there's some question in my mind as far as is it really necessary to add this A value, because it is affecting us to some degree, and I did want to show you one thing about where all this comes from. You can always look at the Bodie Kane Martin text, which is really great. Okay, so at this point I want to talk a little bit about what is this A value and what is the Y and what is the Y star, because you may be thinking to yourself, okay, at this point I want to optimize this. If I want to put real money into these investments, I want to understand what all the components are that are affecting where my weights are going, how my weights are being decided. So you're going to notice I just changed this for a simple example. I copied and moved these real returns that I had over here and just replaced them with some more reasonable numbers, 4%, 5%, 6%, 9, whatever. Okay, so and then we know that the risk-free rate is currently about 1%. Okay, this is going to be important, as we'll see here. The A value, let's take a look at this. The A value, it says it's risk aversion. So the more averse to something you are, it means that you don't like something, right? So a 5 would be I really, really hate risk. I want to have very low risk exposure. That's a 5, okay? A 0 would be a person they call a risk lover, where they don't care. It's like they're trying to squeeze every extra percentage of return that they can get. They don't care how much risk they're exposed to. So 0 to 5. Now, there's books that like Investments from Bodie and Marcus is a popular one. They're the ones that use this scale. They're not the only ones, I'm sure, but they talked about it in their textbook, which is very popular, very well respected. And they do say that it is a little bit of an arbitrary measure, but you have to use some kind of measure. Okay, so 0 to 5, they could have used 0 to 10, they could have changed it around, whatever, but 0 to 5. So that's what the A value is. Now, if you're going to be maximizing the Sharpe ratio, one of the things that you can do when it comes to setting your solver is you can basically tell solver, hey, give me the best Sharpe ratio with an A value anywhere below 5. And so you can see that that's what I've done right here, J22. This is J22, you can see it on the screen. And the restriction is, or the constraint is, set J22 below 5, anything below or equal to 5. And normally what it's going to do is going to run it all the way up to 5. And why is that? It's because with the Sharpe ratio, you got to remember that your denominator is your standard deviation. And so it's trying to basically, it's going to be highly interested in lowering that denominator when possible. So why I say all that is because basically the A value links into this whole system at the Y star component. So we'll look real quick, again, review the Y star, and then I'll explain what it is. So the Y star is the returns of the portfolio, the blue one, 7.3 here, minus the risk-free rate, the red one, divided by my A value of 5 times the standard deviation of the portfolio squared. Okay? So let's talk a little bit about Y star, what it is, and what it's doing. So essentially, you should think of Y in general. Let's start with the concept of Y. Y is essentially what the book uses to talk about your investment of your cash that you hold into risky assets. So in this system, the idea is basically there's only two options. It's either, am I going to put my money in the risk-free rate on one hand, or am I going to put it in a risky asset on the other? So the risky asset could be any number of stocks, risky bonds, foreign bonds, corporate bonds that have a low credit rating. You could say all those would be risky, okay? Everything else would just be in this risk-free rate that we're choosing. So why then would be, let me give you a couple examples of why. If I decided that I wanted to leverage my position, I wanted to borrow money in order to put more than what I actually have in this portfolio. What that would mean is I would put all of my capital, all my cash available for investing in, so that would be Y equals 100%, plus I'm putting 40% of someone else's money. So that makes my Y 140% of what I have, okay? So Y can go over 100. Now, Y star is the optimal amount that I should put in. So under certain circumstances, depending upon any restrictions that you want to put on the Y star, the best for you might be to borrow 400% if you're open to borrowing that much money. Or it could be, no, only invest 27% of your money in risky assets and put the remainder in the risk-free rate. And so I'm going to show you a couple of different scenarios, but of course you might understand that decision is going to be based largely upon, well, how much money am I going to get at the risk-free rate, right? Currently, getting less than 1%, so it's not a very attractive investment. But if it was to go up to, say, 6%, 8%, then the optimization program might say, wait, hold on. We actually, it's more beneficial to put some of that money in those risk-free bonds, those risk-free treasury bonds. So I'm going to run two examples really quick. You can see some of the weights. The Y star is currently set at 100. And I just ran it, and I got a Sharpe ratio of 0.561. Now, that's with a risk-free rate at 1%. Let's say, I don't know, the central governments, the central banks, they're seeing lots of inflation. They want to raise interest rates to try to combat that. Let's say interest rates go to 8%. So now I can put my money in at 8% risk-free, and a lot of these other options here are only going to be 4% with risk, 5% with risk, 6%, but I do have some 9% things here with risk. So we'll try that, and we'll rerun it. And what should happen is that the Y star should drop below 100%. It should be, I don't know, let's see what it says. 4%, 22%. Okay, it has converged to the current solution. All constraints are satisfied. Great. So what this basically says, and under this scenario where I have certain restrictions, I don't want all my money in the pink, I want some in the pink and some in the green, in that scenario. Okay, so once we ran that, we saw that we got a Y star of 21.72. And what that basically means is, say in general, let's talk about this first. That means if I'm investing $1 million, that means 21.72% of that million is going to be in the risky asset. So I put money in Y, and you see how that carries over perfectly. 217,224, and this is 217,224. Okay, so multiplying by that million makes it really easy to understand what's going on here. That means that if that's the amount of money that's in the risky assets, everything else is going to be in the risk-free rate. And that's what I should have called it instead of saying in cash. It should have been the risk-free. So I hope that's starting to make a little bit of sense. Again, if we want to know, well, okay, how much money am I going to put in CCI? Well, 20% of my portfolio weights, these are of my risky investments, 20% of my risky investments are going to go into CCI. But we're really doing 20% times 0.217, this number here, times the million. And so that should make sense. The million times the 20% times the Y star. So that's what's basically going to happen anytime that Y star would drop below zero. And you could see that happening whenever you have, assets that are returning less than what you can just go to the bank and buy in treasuries for a preferred rate, a preferable rate with much less exposure to risk. Like I said, some of these stocks that I have in here, in real life, they have these much, much higher returns. And so in order to make this example, I had to knock those returns down quite significantly. But you could see that if they were giving these low returns and the risk-free rate was much higher, well, there you go. So, so I just wanted to try to explain that. Let's see all of a sudden, the economy stabilizes, the risk-free rate goes back to where it is now, 1.0069%, less than 1%. Then we could go back to data. We could rerun solver. We don't need to do anything different, keep all the constraints, just hit solve. And with that new risk-free rate, much, much, much lower, I mean, that's over 700 basis points or 7 percentage points lower than what we just had. Under those circumstances, it's definitely going to want to put 100%, it's a little bit of an error there, but 100% into the risky assets as opposed to the less than 1% return at the risk-free rate. So I hope that makes sense about what is Y. Again, Y is the amount of my money that I have invested going into risky assets. Y star is the optimal, the best percentage of my money between my two options, risky and risk-free. It might be, best case is 80% risky, 20% risk-free, or it could be 100 and 0. And it just depends upon the risk, as you know, and the returns that are expected. So that's essentially what's going on there, how to understand it, and you can do some math a little bit with, I think this is really interesting if you're still curious about how to understand this equation. Okay, so now I'm going to try to really take a deep dive into thinking about why is Excel always driving my A value up to 5 when I allow it to, when I put the constraint that the A value can be anything less than or equal to 5. Well, first we have to realize that there's a couple different things going on. A, in general, we're trying to maximize the Sharpe ratio, this here, right? And what is the Sharpe ratio? We want the highest returns are desirable and the lowest standard deviation is desirable. And how are these things calculated? How is standard deviation working in this whole system? Well, in one part we see it in our Y star equation. We can see it here in the green, standard deviation squared. That's part of the Y star formula. And the whole thing is expected return minus the risk-free rate divided by the A value that we choose times the standard deviation squared. Now, we need to set Y star. It can't just be anything, right? We set it to less than or equal to 100% because we don't want to borrow. Or maybe you want to borrow, but you only want to borrow up to 140%, or 210%, or 300%. But you just don't want to go into the moon. So you're going to put some restraint on there. And as we talked about before, anytime the Y star is less than 100%, it means that if the Y star is like 80%, it means 80% of your money should be invested in the risky assets, and the remaining 20% should go into the risk-free government bonds. Okay. So back to this. So we know that the Y star has a limit. It just can't be anything. It has to be at maximum 100%. So we're looking over here, and this program is dealing with the A value and the standard deviation. Well, we know the expected returns minus the risk-free rate. It's basically fixed. I mean, my stocks, they have the expected return that they have, and yeah, there's a little bit of wiggle room as far as the amount that, depending on how we mix it. But basically, I mean, those things are set. The same is true basically for the standard deviation of each asset. I'm not going to be able to manipulate that. It's going to give the return that it's going to give historically, and it's going to have the standard deviation that it has. I can't change that. The only thing in this formula that I can really change is the A value. And the A value, it's up to the investor. They can pick anything, like we said, from 0 to 5. Now, let's look at this. I set up a simple example where let's say that we want to have our y star equal to 1. Just like we said, 1 would be equal to 100%, okay? And we're using the exact same formula and just adding some numbers, all right? The numerator divided by the denominator. So let's say our portfolio gives us an expected return of 30%, okay? And the A value would be the 5 in this situation, the purple. And then in order for this to equal 1, which we want it to equal 1, we need the green to be 6%, right? 5 times 6, excuse me, is 30. That'll give us 1. So all we're going to do is we're going to repeat the same process, keeping the numerator the same, keeping the output equal to 1. And the only thing that we're going to change in these is we're going to pick a new A value and see what that does to what has to happen to our standard deviation. So if we go down here and we drop our A value to 4, well, that means in order to equal 1, we have to have 7.5% for the standard deviation. Make sense? Or if we drop our A value to 2, then our standard deviation has to go to 15%. And if we do it one more time with the A value, if we drop it down to 1, we're really risk averse, then that allows our program to run our standard deviation up to 30%. Now, the thing is, we have to realize that these standard deviations, this 30% is representative of this whole green term, okay? So I try to make it really easy, and it's especially easy, I guess, up here at this top one. If the A value is 5, the green term has to be equal to 6%, okay? Well, since we know that square root is in there, basically what we want to do in order to understand this standard deviation, this is standard deviation squared, and we want to know what is our allowable standard deviation. So to go from a squared term to just to the power of 1, we need to take the square root, yes? So all I did was just take square root equal to 0.06 equal to 6%. And under that situation, I'm allowed to have a standard deviation of 24.5% basically. Well, as my A value decreases from 5 to 4 to 2 to 1, you're going to know that my standard deviation is allowed to actually increase quite significantly. So my standard deviation is jumping 27%, 38%, up to 54%. Now with this new information, once we see, okay, every time that I drop my A value as an investor, it means that this program will basically, all things else held constant, assuming that my expected returns are the same, then it's going to drive this standard deviation up. Remember, the lower numbers are, a 0 would be a risk lover. So a 1 is almost a risk lover. I'm fine with risk, right? That's no problem for me. That's what we're basically saying at by the time we get to an A value of 1, which means that in the formula, it's going to allow my standard deviation to basically be set at the limit of 54%. Well, you can see why if we went from an A value of 5 down to 1, our standard deviation, it basically doubled. So you'll notice with each drop of the A value here, if I go from 5, it allows me to have a standard deviation of 24%. But if I drop it down where I'm a risk lover almost, and I'm at an A value of 1, then my standard deviation is now able to go as high as 54%. We have to remember these standard deviation numbers are in the denominator of our Maximize Sharpe Ratio. So if we basically double the standard deviation number from here to here, then we're going to also need the numerator to double from 4 to 8 in order just to stay at the same place we are. So this is really going to be maybe not very possible to get that much extra return proportionally for each unit of risk. So assuming that there aren't just crazy returns that you can get out there, it's not like there are stocks that we can find over to the last 5 years that have maybe double the amount of standard deviation, but I mean maybe have just 80%, 40%, just incredible gains. It's probably very unlikely that that's going to happen. That you're going to have, it's not that likely to see just incredible gains up to, if I quadruple my risk, then I'm going to be able to quadruple my returns. It's not likely to see that. And even in this example, I mean, many of these stocks are speculative stocks, and yeah, I mean they have great returns, 20, 18%, 24% average over 5 years, but it's not like I'm going to be able to go out and find a bunch of stocks that have 40% returns 5 years in a row. It's just not possible. And some of those, they can have very large betas over 2, large volatility. There's a company, FCX. It's a Freeport McMormaron, I believe. I always have a tough time saying it, but it has a lot of volatility, and it doesn't have these incredible gains like you're seeing. So my guess is for your average stock, what it's going to basically do is it knows that it can't run proportionally. This numerator cannot keep up with the denominator. You can go out and you can find a lot of risk, but you can't go out and find a whole bunch of extra returns for each unit of your risk that you're taking. And so what it basically does in most cases is it's going to basically say, okay, if I can't really win up here in the numerator, I'm going to figure out how to win down here in the denominator. And what I'm going to try to do is basically make this denominator basically small. Basically try to make it small in order to maximize the Sharpe ratio. And the way that it can do that, yeah, it can a little bit, adjust its mix, but if you give it free rein to adjust the A value, it's going to do that a whole lot easier. And so it's going to run that thing up to 5 for the reason that we're seeing here, because these things jump really fast. A 5 to 4 is only a small change in the standard deviation in our example. Okay, so working with the same table, what I did was originally I ran with the expected return of 30% here in the numerator, and I wanted to see, we already knew what the standard deviation, how it changed at each level of A, as A went from 5 to 4 to 2 to 1 in the purple. And we saw that our standard deviation jumped from 24% to 27% to 38% to 54%, so that was over a doubling in the allowable standard deviation. I wanted to know what's going to happen if I change the numerator to an expected return of 8%. So 8% in all the numerators, still want our y star to equal 1, and we're going to adjust the a value down the same way, 5, 4, 2, and 1, and then we just have to solve for what then would our value for the standard deviation in green be at each level. 1.6 here. 2, you can see 4 times 2% is going to equal 8%. 8% over 8% is going to give us our 1. Same thing here, really easy to see. 2 times 4, 8 again for a factor of 1. And 1 times 8 over 8 is again 1. So now with our new standard deviations, just took the square root of the green term. Since this is standard deviation squared, we want to know what standard deviation is, because that's what the Sharpe ratio uses. It doesn't use standard deviation squared, it uses standard deviation. But basically what I'm interested in is what's the rate of change. And if we use that A value of 5 as the base, we want to know, okay, if I'm willing to take on more risk, going from level 5 to an A value of 4, that's more risk I'm willing to take. How much is my standard deviation always going to jump the same no matter what my returns are in this sense? If we go from level 5 to, this should say level 5 to level 2, which I know that skips, we skipped a bit, we skipped 3, but if we go from 5 to 2, we're willing to take on 58% more standard deviation, more risk in our portfolio. If we go from 5 all the way down to 1, as in this one, 123% more standard deviation we're willing to accept. So, and we saw that already, 24%, 0.24 to 0.54, or the same thing, 0.126 to 0.28. So these numbers are really the same, and so that's why, since we're seeing such massive moves in the standard deviation jumping so much, jumping exponentially basically, we know that our returns here in the numerator of our Sharpe ratio are not going to be able to match that. We're not going to be able to say, oh, give me 5% more standard deviation and find me a stock that'll give me 20% more returns. That's not going to happen. That's just not going to happen. So that's why in most scenarios, if you're wondering why does the solver solution always run my A value up to 5, Well, basically, it's like unless you're in a really unique situation, the returns are not going to be able to keep pace with the exponential growth of the standard deviation. And you can see that here through these simple examples, holding these things constant, the expected return, holding the y star value equal to 1 in every scenario, and just manipulating, just changing the a value at each level and seeing what then must be the effect that would have on the allowable standard deviation. We see that it's quite significant. It's jumping more than double, and if we want to know what it is at each level, it's going to be 11% for that first level, but then it's exponential growth. If you go from 5 to 2, it's 58%. If you go from 5 to level 1, you're going to take on 123.6 percentage points more standard deviation. And in most situations, like I said, the returns just aren't going to be able to keep up with that. So I hope that helps explain that part. Okay, so I really liked using that smaller example that only had the 10 stocks. It makes it a lot easier to not have to move the screen around so much for you guys to see all the different cells that we're looking at. And but basically that's not going to be enough. You probably want to, once you start building your own, add some extra features. So I'm just going to start, I guess we'll just start on the left and we'll just work our way right. Okay, so essentially one thing that you can do is you can just, with an email and password, you can sign up for Moody's credit rating, and you can see here, this is how it works with them. They have basically in this top section, investment grade, and so for Moody's it's a AAA down to Baa3, and it's different for S&P and for Fitch's. But most of the time people quote long-term credit ratings. You could look at the short term if you're more interested in that and set up some kind of system. But basically, you want to be aware that what are the credit rating agencies saying about the companies you have, their ability to meet their short-term, their long-term debt obligations. And it's also a good measure of, there's a lot of companies that are going to go bust in 2020, 21, 22. It just depends, but we've seen Hertz, we've seen J. Crew, we've seen a lot of the bailouts have happened in the States, but definitely companies are, they're going to struggle. And so you want to have some kind of way to factor that into what you're doing, to the way that you're thinking about these. And like I said before, it depends upon your theory of the markets. Some people would say, well, all that risk is already priced in. So when I see a stock trading at $212.18, it means that every aspect has been, figured in by, say, institutional investors or, whatever. It just depends. If you agree with that, then there you go. You don't have to do any extra legwork. If you are more worried about default or speculative grade investments that you're looking at, or a lot of investments have even been downgraded recently, like Ford Motor Company, for example, is now a speculative stock. So that's one thing to think about. So you can go to Moody's and you can download the data and then you can drop it right in here. So I did that here in this column you can see. And it basically, if it was a speculative stock, I put it in a red font. And so you can see that there's a number of these that are speculative or non-investment grade stocks, while others have pretty good ratings. So it's nice to have the tickers at least always on the screen where you can see what you're doing. You don't have to move around so much. I did something that it's just, you have to come up with some system, some way to quantitatively assign the bonus or the downside for credit default. So basically I listed all the ratings Moody's uses. There's 21, so 0 right here leaves 10 above and 10 below. And then this green is the bottom of the investment grade section. And so you could do something like what I did, where at each level I'll assign a number 1 to 10, -1 to -10, 0 here for BA1. And then you could basically assign some multiplier to it. You could use 5% or whatever you want. And then you can do a credit rating bonus. So like this stock, Broadcom, it has a BA3. So BA3 here is one level above 0. So it's just barely investment grade. So don't want to give it some kind of bonus for that. Sure, okay, I can give it half a percentage point, Or you can change the multiplier to whatever you want. You could do it, 3. 3/10 or 2/10 or whatever you like, but it's just some way to factor it in. Other thing you can add in is an expense ratio. So if you're trading any index funds or ones with management fees, you might want to add that in. I saw one recently that was high as 1.9 annually. So that's a big chunk of change. If say you're only making 3%, they're going to take 1.9. That's huge. You should factor that in. You shouldn't just think that that's nothing. Also, you want to add in your dividends, your dividend yields. So because they are going to pay that out annually. And if you expect any special dividends, you might want to think about that as well. Of course, during this time, I've seen a lot of companies cut dividends. I saw one company cut from, I think it was like 79 cents a quarter down to a penny. So that's always the thing. In tough times, companies are going to do that. The other thing is beta. So we haven't talked much about beta, but we did pull it. You can pull it off Yahoo Finance or a lot of other different sites. And one of the things that you can do is once you have all the betas, then you can match it up with your weights that you're going to have for your portfolio, and you can get for yourself a weighted average for your betas, which will give you the beta of your portfolio. That's all it is. It's just a weighted average. You're just doing the matrix multiplier transpose. You're doing your betas, comma, and then the array of your weights. Double close parentheses. Don't forget that control shift enter anytime you're dealing with matrix multipliers. So why is that nice? Well, that's nice because we just went through all that issue about the A value and the way that the A value affects the Y star, and how all those are tied to your standard deviation. Well, that might be, you might not like that system, or you might want it just for funsies. You could use the Treynor ratio. You could have another look. You could have a different opinion where you're basically taking your expected return minus your risk-free rate in red and dividing it by the beta of your portfolio. And so you could maximize that, and that would give you, different weights. And you could say, this one stock is really, it comes out much differently in its weighting in one system versus the other. And like I said before, in the textbook, there's a couple things. One, the textbook, I remember it saying, so you have the Sharpe ratio, you have the Treynor ratio, you have the information ratio, you have the Treynor ratio, and I think it was about the information ratio that it's preferable if you have a non-diversified portfolio. So one, double check that, go to your own homework, because I don't have that written down, and the reason I didn't write it down is because the term diversified is, it's uncertain, it's a bit subjective, it could be argued about. I certainly don't have a diversified portfolio here. I have all equities, basically, and some REITs, but I don't have any bond funds. But even if I did have some U.S. bond funds, then am I diversified at that point? Well, I don't have any emerging markets. I don't have anything from China. I don't have anything from Europe. Is everything denominated in U.S. dollars? Well, then maybe I have a currency risk. There's all kinds of different ways that you could talk about it. Maybe I have bonds and equities, and I have them in the U.S. and I have them in, say, all the continents. But everything is in healthcare, and I don't have anything in energy, or I don't have anything in, say, automotive or telecom. Well, then I'm not diversified either. So it matters, and so check that out. Do your homework and look into that to see which ratio is preferable for you and your circumstances. Anyway, I'm going to go back up here. So we talked about the ticker, the expense ratios, the credit rating bonus if you decide to do that, the annual dividends, the betas. Now this is really interesting. If you remember, we went before and we calculated the monthly standard deviations. I know you guys remember that. It's been a long time ago, but we did that very early on in the process, where you came here and you got your geometric monthly average returns and you got your sample standard deviation monthly. Well, we have those. And since we already have those, why not let's do something like find out the average price for my stock. It's been very volatile the last 6 months with the Rona, but let's go get Broadcom. Let's get the average price over 12 months. I have that data right up here, or just over on the other side of the sheet. I can find that. So boom, I'll do that right here. 12-month average price, June to June, last 12 months. The price was $279, and then I can apply the standard deviation that I have for that, so the 1 month standard deviation. And if I want to do it on the downside, it's fairly simple. I'm going to take the stock price times 1 minus the number of months, that's in the purple, times the standard deviation, the monthly standard deviation that I have for the stock. Okay, so that's basically going to give me how do I expect it to act on a downward side. I want to get into this stock, and I'm looking for what's a decent target price, what's a legitimate or reasonable target price. So 1 month downside, I could probably get it if I'm willing to wait a month, about $260. The lowest price I'll probably see in a 3 month window is $244. And then if I'm willing to wait half a year, I might be able to see it go as low as $266. Now, this is not like a perfect system, right? This isn't talking about anything to do with the factors that are going to also influence the stock price. The GDP growth, if it's positive, then it might jump up to another level and then retrend along that. That's a little bit getting into the technical side of things. But basically, if you're talking about an average, yeah, you are going to have some variation around the average, but and not if not if they acquire a new company and they see a huge jump in their stock price. Not if some major outside force changes everything. Then these numbers are not going to be applicable anymore. But for now, it's the information that I have, and so let's use that at least as a guide to be able to think about, if I want to buy this, what do I want to buy it at? So one thing I did, you can see. Let's go down here to this one. You can see these three dark greens that I put in. So this is RTX, this is Raytheon Technologies. So it's currently trading at $63. Well, on the 12-month average, the 1 month downside, I'll go back over here. What was the 12-month average on Raytheon? RTX, 12-month average was 79 bucks, okay? So 79 bucks was the 12-month average, which make my downside opportunity around 73.66. I expect to maybe buy that within a month window, maybe if I had a bad month. Now it could be on the upside, So, but 73.66 would be, something to take notice of. 3 month downside 69.62. 6 month downside 65.66. So I might have to wait 6 months, say, to be able to get it at 65 bucks. Well, the thing is, when I checked yesterday or on Friday, it was trading at 63. So I darkened all these categories. It meets the 1 month downside. It surpassed the 3 month downside. It even surpassed the 6 month downside. So I thought, you know what? I'm going to look into the stock. If there's nothing crazy that's really happened, besides just like the normal stuff, a lot of these stocks are down, but not this much. Not based on the number of deviations or the number of monthly standard deviations. It's not down. A lot of these aren't, but some of them are. Groupon, USB Bank is down. All three, Boeing, all three, AT&T, 2 out of the 3 months, Ford, 2 of the 3 months. And so you can just see that's an interesting way, a way to add it in, because a lot of times people, they have no method for, should I buy it at $4.80 or, do I need to wait until it gets to $4.60? People, they don't tend to seem to have like a lot of good ideas or good guidelines as far as, what's my target price. So we have the share price. And then everything else is just based on basically the weights times the amount invested. So like 9,464.56. If that's the total amount to be invested, basically, you could set it up where you have basically it'll tell you an amount to be invested. So the 4% that I'm going to put in times the portfolio means that I want to put in this stock 378 bucks. Okay, well, it's trading at 295, so I can buy 1.3 shares. If you have one of those systems where you can brokerages where you can buy fractional shares, that's good to know. I have in Charles Schwab, they do have fractional buying, but not on everything. They have like 500 stocks you can do fractional sharing on, and they reserve the right to change that list at any time. And so that's something to be aware of, because you can see, like for me, a lot of these stocks, since I'm not investing tons of money, 1.3 shares, 1.5 shares, 15, 16, a bunch of them with 0. So the algorithm or solver didn't like a lot of these stocks, so there's no money going into those. I'm not buying any shares. But, they're all fractional. And some of these are like very expensive. Like Tesla was on here, and it's like $930 a share. Well, if you have to buy a whole share, and in fact I had to recalculate that just to see if it was possible and what it would look like, because I couldn't buy a fraction of a share of Tesla. I had to go the whole boat at 930 bucks. So that's a big chunk of change for a portfolio that's only, that's almost like 9 or 10% of the entire portfolio. So that was a lot. The tickers, like I said, you can copy and paste the annualized returns that you did from your Excel sheet. I'm talking about these ones right here. The annualized returns, not the excess returns, just the annualized returns. You can copy and paste the values in. And then what you can do is you can go from that and you can add in whatever. If you want to give that bonus boost for the high credit rating, if you want that to factor in, you can do that. If you want to subtract off any expense fees or management fees or anything like that, then that will give you a more accurate number for, you want it to basically pick your best stocks, right? For me, I'm more interested in getting in the right stocks at the right percentages than this number down here being absolutely spot on. It says that I have expected return of 10.5% on this portfolio, a standard deviation of 14%, a Sharpe Ratio of 0.7. Now, if I inflate some of those returns because I want to put some value on the credit, a good credit score, a good credit rating, protection against default and things like that, well, that's going to drive this expected return up. Okay, for the portfolio, at least for those stocks. Now, it could be that some of the other ones, I discounted them. Like I said, I have a lot of speculative stocks here, and so like for this one, B3, I'm subtracting 2.5 percentage points of return off just for this chance of bankruptcy or default or insolvency. So, it's going to basically make this expected return not 100% spot on. Who cares? I mean, that's my perspective. And I guess I'm supposed to say at some point in this video, like, I'm not a financial advisor. I'm not here to give you advice. This is just simply for entertainment purposes or educational purposes, or so you understand how Excel works a little bit better. Please don't copy, this portfolio, or go with any of these stocks and put money in them just because you saw them on a YouTube video from some guy that you don't know. Do all your own work, and that's the best plan. But I think you get what I'm saying. If my expected return is a little bit off, so what? What I'm most interested in is getting in the best stocks, and I know that the statistical data that we did, the statistical work that we did on the standard deviation, that there's no aspect of that that's going to, factor in a credit default probability. So, anyways, I think you get my point. Like I said, you can always maximize the Treynor ratio instead. Oh, finally, these are the last things. You can set all kinds of, for example, like this. How much of my weight is going to go into mining stocks? So all my mining stocks are in pink. So I want to sum all those weights here in this cell, and then when I go to the solver solution, I can put in a constraint that says, I want at least, I want this cell to equal 25% or more. I want this cell to equal 25% or more. I want this one to equal 15% or more. I want this one to equal, no more than 10, less than 10%. Or less than 15% or whatever, and I want this one to equal exactly 18%. You can do whatever you want, equal to, less than or equal to, greater than or equal to, but what it basically does, it allows you to get some kind of mix, so that, this program will basically, at certain times, I remember at some points it had, over 70% of all the money going into mining. I was like, I don't want all that money in one sector. I do think there's opportunities in these other sectors. So, but that's something you should definitely, a nice aspect you should add in. I think that's it for now, y'all. I think after this, the only other section is basically a general approach to how to pick stocks, how to pick sectors, how to look at the broader economy. Do you want to do a top-down or a bottom-up approach? And of course, there's a lot of other stuff to learn, but it's been really fun, and I hope you the best out there. One thing I always suggest is you definitely look into, if you're in the States, they have the same kind of thing in the UK by a different name, but it's like the Roth IRA, either Roth or traditional IRA. Basically, for the American viewers, basically the Roth is after-tax money that you put in. So say like your stimulus check, if you got that, right, you don't owe any taxes on it, or taxes have already been paid on that money. So throw that into a Roth, and when you take your money out, you won't have to take you don't have to pay any taxes on the principal or on the dividends or the earnings if you take it out after you're 59 and a half. So check into that. If you're working and your employer has a traditional IRA, then you can, before the taxes get a hold of any of that money, you can move it over into a traditional IRA and let it grow tax-free over there up until the time you take it out. It's a little bit different, but I would definitely suggest looking into that before you get real serious. So there's really two ways of looking at stock investing or building a portfolio. One is what they call the top-down approach. And by the top-down approach, you mean you take the bird's eye view. You start from 1,000 feet up, and you look down on the whole world. You look at all the different indicators, the things that you see is going on. You could look at the jobs claims, the unemployment claims. You could look at GDP growth. You could look at real GDP growth. You could look at inflation. You could look at, say, trade deficits. You could look at changes in taxes. Say, for U.S. under Trump did a lot of changes as far as the corporate tax brackets and the burdens for companies in that sense. Some of those are also going to expire for, not for the corporates, but for the everyday taxpayer. Some of those are going to change, I think, in 2023. So you may be looking at some of those things. You may be looking at the stock market. Like we said before, you may be looking at, well, what is going on? How can you have, 13 to 20% of people being unemployed, and yet the stock market is, doing really great? How is that possible? So you might have to try to sort that out. You could look at all kinds of other indicators. And in fact, if you want to do that, here's an interesting book. Someone just told me it was really super boring read, but it's called The Secrets of Economic Indicators. It's basically like 400-500 pages just of indicators. So you have lagging indicators, coincident indicators, and also leading indicators. So some of these things are going to tell us a little bit about what happened previously. But the ones that people really like, if they're trying to basically time the market or get ahead of the game, predict what's going to happen in the future, and invest based on those types of things, they like to look at the leading indicators. And so you could go to your local library, you could go online or buy a similar book or look into all that and track certain things, inflation rates, the CPI, the new jobless claims. Or you could look at things like applications for new construction. You could look at all types of, there's literally like hundreds of things that you could look at. One of the big ones is S&P 500, or the stock market, is a great leading indicator. So a lot of people follow that, but there's so many. So you could try to sort through some of those things, demand pull, any kind of things that are going to lead to inflation, a cure, possible cure, or you could see a possible resurgence in the fall. And you may say, you may be a big bear. You may be one of these people talking into the dollar, or at least to the petrodollar, and yada, yada, yada. So you could get into all that, right? And that's one way to do it. Try to understand the macro environment. Try to understand, do we have a housing bubble like in, 08, 09, be Michael Burry, in the Big Short movie, and see it coming, where Silent Capital makes, I don't know, 500%, or I don't know what they made, 2,000% or something. So you could try to be one of those people, go into the data, look at the indicators, and try to make your prediction, and then buy accordingly. The other thing that a lot of people do instead is basically the exact opposite. It's not the top down, it's the bottom up. And by bottom up, they mean you start with maybe a single company, or maybe like a handful of companies, maybe 2 or 3. And these are like your superstars. These are your key players. And then you're going to build a franchise around those pieces, those key pieces. And so if that kind of thing describes you a little bit more, then you're going to have to figure out, well, how am I going to, build around? And if that's your big like horse that you're betting on, the Tesla, for example, well, what other pieces do you want to get in there, and how do you want to kind of maximize those other pieces in order to, say, like maximize a Sharpe ratio, maximize a Treynor and information ratio, expected gain that you're going to get for the expected risk that you expose yourself to. So with the gains on the numerator, the risk in the denominator, that fraction will give you basically a sense of, how much am I getting paid for my risk that I'm exposing myself to. Well, the great thing about all this is if we do a lot of legwork, we can come up with an optimized portfolio. And then once you get that set, if you're going to just really ride that train for a long time, then as more money comes in, then you just buy in those same percentages. And you don't have to do a lot other than that unless you want to make big changes.